CAPM stands for Capital Asset Pricing Model, which is a mathematical model that estimates the expected return of an investment based on its riskiness relative to the rest of the market. Basically, it is the relationship between systematic risk and the expected return for assets, especially stocks. So, what is systematic risk? Systematic risk refers to the risk of the entire market or market segment. It is also known as undiversifiable risk, volatility, and market risk. It affects the overall market, not just a particular stock or industry. It is viewed as unpredictable and being difficult to avoid. This is the formula for the CAPM model. The ERI stands for expected return of investment. The RF stands for risk-free rate. BI stands for the beta of the investment. And the ERM minus RF equals the market risk premium. The goal of the formula is to evaluate whether a stock is fairly valued when its risk is compared with its expected return. Example: imagine an investor is contemplating a stock valued at $100 per share today that will pay 3% annual dividend. Beta of the stock compared to the market is 1.3, which means it is riskier than a market portfolio, which has a beta of 1. Let's also assume that the risk-free rate is 3% and that the investor expects the market to rise in value by 8% per year. If we put this information into our formula, we get an expected return of 9.5%. Using the CAPM to build a portfolio is supposed to help an investor manage the risk. If an investor were able to use the CAPM to optimize the portfolio's return relative to risk, it would exist on a curve called the efficient frontier. This graph shows how greater expected returns, which you can see on the y-axis, require greater expected risk, which you can see on the x-axis. Moden Portfolio Theory suggests that starting with the risk-free rate, the expected return of a portfolio increases as the risk increases. The CAPM uses the principles of Moden Portfolio Theory to determine if a security is fairly valued. It relies on assumptions, but it can help investors understand the relationship between expected risk and reward as they strive to make better decisions about adding securities to a portfolio. Thanks for watching.